We have been told over and over again that gold and silver are here to protect us against inflation. Well, today, inflation is rising yet again, and gold and silver are falling. Why is that? I'll answer that question in this video as we explore. It is very easy to get frustrated in this day and age. We have been seeing inflation on the rise and sticking with us for quite a long time. So movements in the markets today leave us scratching our heads from time to time. But in reality, there is an easy explanation for this. Well, maybe not so easy, but one that can be communicated. And I hope to do that now in this video. See, we're seeing inflation rise up. And the dollar indeed is suffering a bit in terms of its loss of value. But the strength of it is actually rising. And that is putting pressure on the metals. So why is that? Well, we can get some clues based off of what Reuters is telling us here about what happened in the market. But we can also just look at the natural psychology of the markets as well. I'm going to put it all together for you here. But first, let's get a little report on what's going on in the markets. Right now, every metal is down, save for palladium. It's up slightly. Gold is down over 1.2% right now to $2,156.70. As I report to you moments before the markets close, silver is down 35 cents today. That's down 1.45%. So it took a little bit more of a beating than gold did, down $24.17. And platinum is down $14. So there's your report on what's happening with the markets. And inflation is actually up. Gold and silver are under pressure from the Fed rate cut doubts. And that's really what's behind all of this, based off of what the inflation numbers that surprised most of the market today. Gold prices are under pressure, dropping more than 1% after a hot U.S. inflation report dimmed prospects of the Federal Reserve cutting interest rates soon. Spot gold has fallen, and I just gave you the numbers there as to where the markets are moments before they close. U.S. consumer prices increased solidly in February, suggesting some stickiness in inflation, according to Reuters. And data show the consumer price index rose 0.4% on a monthly basis in February. Annually, it has increased 3.2% above the 3.1% forecast. So it's actually hotter than usual. They say here that CPI comes in a bit sweaty, and that's an odd adjective to use. But the market was expecting a high print, so the initial reaction was a bit muted, but prices have been volatile since, according to Tai Wong, a New York-based independent metals trader. He has gold bulls would be still look reasonable to drive it higher, but the focus will shift to next week's Fed meeting, where there will be an updated dot plot referring to central bankers' interest rate forecast. And that dot plot does tell us something, and I don't follow it too closely, but that can make or break the markets at any given time for at least a week or so. The market, though, is still pricing in around a 70% chance of a U.S. rate cut in June, according to the CME Fed Watch tool. The next U.S. bank meeting is due out in days from now. And 99% say that we're going to leave rates the same. And in May, too. But in June, really not much has changed, according to the Fed Watch tool. But I guess once these numbers are absorbed by the participants, then we may see a change and a shift in those numbers, and that's going to drive the markets one way or the other, likely, if they don't think they're going to do it till later. And I've always been of the mind that it's not going to come until at least July. I still stand with that, even though most say it's going to happen in June. Low interest rates help gold prices as they reduce the opportunity cost of holding the precious metal that earns no interest. In the short run, prices will see consolidation and probably stabilize around the $2,100 level and break above $2,200 by the end of the second quarter of this year, according to Akasi Doshi, who's the head of Commodities North American CTI Research. And so that's the sentiment here. So basically, the short story here is that whenever there's a chance of higher interest rates for longer, well, that means since gold and silver don't pay you an interest, they're going to go to interest-bearing assets. And there's going to be a little bit more and find things like money markets and other accounts where people can make money safely. The safe haven are in low risk, high interest yielding commodity or assets that are out there. So even though the dollar is losing value, the strength of it is buoyed by these high interest rates. And this is still a period of quantitative tightening, and it may be tight for longer. Now, that tightening is minuscule compared to the amount of dollars that are still out there, especially even overseas. And there's still a lot of delicate situations out there, geopolitics that are into play. And in reality, the prices didn't fall by a whole lot today. Anything more than 2%, I consider a plunge or a sharp decline in prices. These are 1% plus for both metals, which is still a notable drop. And one would think that with inflation sticky, that would mean that gold and silver would be something that people would look to as alternative assets. But that's not the way the market sees it. Because most of the traders, most of the gold and silver that is traded is in the form of derivatives, the paper markets. That's what's driving the price from day to day. Are gold and silver hedges against inflation? No question. But you have to understand that it is really more so up to the individual these days, especially with silver. How and when you buy is crucial in order for silver to protect your wealth. Why? Because silver is seen and traded much more as a commodity these days. It will protect your wealth, but it's a long haul in order for it to do so. And utilizing dollar cost averaging, or a variant of it that I refer to as enhanced dollar cost averaging, is the best way to preserve your wealth with silver. And that means buying it for the lowest premium possible in the most recognizable form out there. And so this is why you should not lose heart, because price is just one measure of the value of a commodity or something. Let me put it to you this way. Think about it in terms of the utility of your vehicle. The car that you drive has there's a market value, but I tell you what, if your car just breaks down and you need a car, yeah, you can find another car, but if you need it for an emergency at any given point in time, it's a lot more valuable then as a mode of transportation than it is for leisure driving. And that is the idea of silver and gold too. In reality, that's kind of the way it is for most commodities. In fact, water. Look how water is so readily available in most parts of the United States and most first world nations. But what about in the desolate, remote villages of Chad or some other village in a desert area in Mongolia, where water is a scarce commodity, worth a whole lot more there? Or goods and services in remote parts of the world typically are more expensive. Gold and silver are insurance and will become rare commodities, especially in great demand in case of an economic or currency collapse. Many people feel we're going to see both in due course. I don't know. I talk about that kind of thing in terms of what other people say about it. I don't believe that necessarily is going to happen anytime soon. The Fed and the government both have tools up their sleeves in order to pull the wool over your eyes in terms of the currency proposition in the United States, and that's leading towards a central bank digital currency. They're going to do that before they are forced into some sort of gold standard or debt revaluation, because right now, the debt is only mentioned in terms of a political ploy. Both parties do it. They only mention the debt when it can gain them political points. When it comes to practicing lowering the debt, no one really cares. The President of the United States just proposed and sent to a Congress a $7+ trillion budget. Absolute insanity. And what is his way to pay for it? By taxing the rich. There's not enough taxes that can be able to pay for this madness and get the deficit. Then we're going to talk about bringing the deficit under control. There's no mention of the debt. And that's a big difference when I talk about that. But nonetheless, this is where we are at. in the United States. And this is where we are at with the precious metals complex today. They are indeed down, but they're not down by a whole lot. And we can take heart and take heed and maybe use this as an opportunity in order to accumulate more if it's so called in your budget. I think this is just a hiccup, and sooner or later I think we're going to see things turn around for gold and silver. Gold obviously is really still trading at an all-time high when it's all said and done. Silver has a long way to go. It's a long road ahead for silver. This is a pretty big scale back, but nonetheless it's still above $24 an ounce. But once we see $24.50 maintained for a while, I believe, as a gut feeling, that we're going to see a potential continue rise up to maybe $26 an ounce. But that's a bit of a ways away to where we'll see that happen. So let me know what your thoughts are down in the comment section below. If you found value in the content that you see and hear on this channel, I hope you will consider pressing that like button down below and subscribe to the channel as well. I would love to have you as a subscriber, and I would like to extend a multitude of gratitude to each and every one of you for taking the time to watch, and to encourage you to please rate, share, comment, and check this video out right here or there.